Let's do this, folks. Good morning, good afternoon. I'm absolutely thrilled to be talking about taxes today. That's the sexiest topic that I could have chosen, right? Now, I actually hate taxes, but I love talking about taxes, as my whiteboard suggests back there, because that is where we can differentiate ourselves from our competitors. Taxes today. I use the GPS analogy. And by the way, before I go any further, tell me if you can see me and hear me. In the chat pane, tell me if you can see me and hear me loud and clear. And if I don't hear anything back from you guys within a couple minutes here, then I'll say, okay, we have an issue here with AV. Oh, already heard. We're good to go. The GPS thing, right? Once upon a time, we didn't have GPSs to get around. Early in my career, I was a regional vice president with ING in the Northeast, so Philadelphia, Pennsylvania, Philadelphia, New York, Boston were big locations for me. Also, at a different time, I was out west in California, and I had my bearings about me. I knew where everything was, east, west, where I am relative to this town, that town. Why is that? Because GPSs didn't exist. What happens today? What happens today is I don't know where the heck I am. I just know that some little voice from some computer from my phone here told me how to get there, right? It's funny, I'll be visiting agents on a monthly basis, you wonderful agents that are working with CG Financial Group, and I'll be in the office and I'll be getting ready to leave. And in that agent, you guys are very giving and generous people with your time. Will say something like, well, where are you going to? Oh, I'm good. I have a GPS. I'm going to XYZ location. Oh, well, let me tell you how to get there. No, I'm good. I have a GPS. Well, you go down 2 blocks, then you head west 3 blocks, hit I Street, take I Street to Interstate 35. Like, I'm good. I have a GPS. The point there is I don't know where the heck I am anymore because the GPS told me how to get there. I don't have my bearings about me. That is like taxes today, TurboTax, or having somebody else do your taxes. Many agents that I talk to, obviously a ton of consumers that I talk to, don't know what goes into the tax calculation. And I tend to think that 20 some years ago, when I did my taxes by hand, yes, I actually did it by hand, the actual 1040 as well as the accompanying schedules. I knew more about taxes then than I ever did. But today with TurboTax and everything, you just input the numbers and all the calculations take place. What happened there? How do you minimize that ultimate tax bill? And that's what we want to talk about today. So we want to forget the tax GPS and we want to dig into it a lot, like almost like as if we were going to do taxes with our pencil here, although we're not really going that deep. But number one today, thank you. Thank you, folks, for a wonderful 2023. Our sales in 2023 was 50% above where they were in 2022. 2022 was 100% above where it was in 2021. And when I say sales, I'm talking about annuities, life insurance, and long-term care. I am your IMO for annuities, life insurance, and long-term care. And because of the wonderful work that you guys and gals have done, we've like quadrupled our business over the last few years. 6 years ago, we didn't even exist, but still, 5 years into it, 6 years into it, I will take those growth rates. So please keep them coming. Ultimately, the goal is to be one of the largest in the country here. We'll get to a $500 million eventually, maybe not for another decade. Heck, maybe 5 years. Maybe we surprise ourselves. We'll get to a $500 million in annuity production. But in the meantime, how are we going to get there? By having the best service in the industry and having the best education in the industry. And there's so much to service to talk about on the front end. Once the cases come in, is there somebody actually managing the cases through the pipeline? Yes, only 50% of the job is done for me, the IMO, once that case hits the door. Anybody that's done an annuity case or certainly a long-term care or life insurance case will tell you that the battle is nowhere near finished once that case goes into the carrier's doors. The battle's only halfway done there. And my job is to see it through to the end. And I have never gotten a serious complaint a serious complaint about our service once the cases hit the door. I mean, occasionally there will be a hiccup. Usually the carrier, it's a crazy world in the carriers today. Usually the complaints come in about the carriers or they drop the ball or what have you. But service is where we separate ourselves. And agents that do business with CG Financial Group, they like the boutique feel, but yet the technology that the big dogs have, right? iGo, Right Now, iPipeline, Firelight, all the technology that you would have with a big organization, except you don't have to deal with a person that was hired by 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 a person to answer the phone calls to do your case design. It is me that helps you do your case design. So in short, thank you for everything. By the way, continue to leverage me. It has almost become a full-time job, me being on Zoom calls with you and your clients. I don't take any split from that. So if the call lasts an hour, that's an hour that I am investing into you and your client. So a lot of three-way Zoom calls, and those Zoom calls usually lead to sales. I don't see who all we have on here, but if any of you have done any Zoom calls with me, feel free to comment here. Tell me what your clients thought of it. But I don't think we've had any Zoom calls that have gone off the rails or anything like that. So continue to use me with things like that. Not only that, but retirement income planning software. If you have a sophisticated client, I have the software that, again, without any split, you give me the metrics, you give me their details, and I can create a beautiful plan for them that the Edward Jones guy or gal, the bane of my existence, Edward Jones, the Edward Jones guy or gal cannot compete with. So anyway, thank you. Number two, seminars. We continue to do a lot of Social Security seminars across the country. Folks, we are averaging around $20 per registrant. So it usually looks like this. Some of you have done this. Write me a check for $1,000. 100% of that $1,000 goes to the marketing of that seminar. How do I market the seminar? Social media is how we market the seminar. And we are getting around, on average, 50 registrants for that $1,000. I don't do what other IMOs do. Oh, we'll take a little bit off the top. That is our administrative fee, so to speak, whether they explicitly disclose that or not. That happens. I don't do any of that. 100% of it goes to marketing, which means that you don't have to play the game of, oh, so I have to write a $9,000 check because my IMO said that I should do at least $3,000, which will buy 6,000 mailers per seminar. But in order to smooth out the highs and lows, I should do at least 3 seminars, which means $3,000 per seminar times 3, $9,000. Don't play that game. I don't play that game. You don't have to play that game. It is, hey, write me a check for $1,000. And by the way, within 3 days of running this campaign, we will know if it's got legs or not. And if you want to turn it off, I'll send you back the rest of your money, period. Or we do an audible and go to a different location. Tip, hint, small towns. Small towns is where it's at with these seminars. There aren't many folks addressing these folks in small town. Iowa, for example, Illinois, Wisconsin, Ohio. You go to a small town outside of, say, Des Moines. This is where I'm at. This is where my office is, right? Des Moines sucks for seminars. One, because it's the insurance capital of the world, but two, it's overly saturated. If you're going to do seminars, I would say favor the smaller towns that are maybe less molested, so to speak. So small towns is where it's at with seminars. There are qualifications. If you do less than $1 million in annuities business, you're not eligible for it yet. I had to switch over to that because what I had is smaller producers that maybe didn't leverage it as much as the larger producers do. It's a territorial thing right now. So I had to kind of adjust the qualifications, $1 million as a minimum to get in on the seminar system. And by the way, we have long-term care seminar and also an estate planning seminar as well. Although the best results come from maximizing Social Security. So that's number 2, seminars. And number 3 here, from a sales standpoint, where are the numbers coming from? Where are the sales coming from? Symetra on the life insurance side. There are cases being issued before those cases, term I'm talking about, Swift term is what it's called. There are cases being issued before it even hits our case management radar. There are policy numbers as well, not just policy numbers, but cases actually being issued within a matter of minutes rather than hours, rather than days. And that is Symetra's Swift Term Life Insurance, their term life insurance, convertible up to age 75, the best convertibility privileges out there. And they have great permanent products to convert to, by the way. Symetra, getting a lot of cases on Symetra. Long-term care, One America. One America continues to kill it, as well as Global Atlantic on their annuity tripler. You put in 100 grand, turns into 300,000 from a long-term care pool standpoint. Very little underwriting, but Global Atlantic and One America in the long-term care space and annuities. It's Athene, it's American Equity, and it's Corebridge. That's where it's at from an annuity standpoint right now for different reasons. Corebridge is big accumulation. American Equity and Athene are mostly about income, although Athene is a great accumulation story as well. And by the way, folks, some of these carriers dual appoint. So if you're with another marketing organization with Corebridge, for instance, you don't have to go to them and beg and plead for a release. You can get an additional contract because they dual appoint. They just say, well, we'll keep your contract here, but with us, Corebridge, we'll also set you up with CG Financial Group, and you can choose where you go to. All right, folks. So what is it that we want to get out of the call today? Tell me what it is you want to get out of the call before we go into just a quick update on 2024's numbers. What is it that you would like to get out of the call today? My goal for you is to differentiate yourself ultimately from your competitors by knowing this stuff a heck of a lot more than your competitors. But tell me what information really floats your boat when it comes to talking about the 1040, taxes, stuff that could easily be really, really boring. Nothing? We have a big audience. We have pretty good audience for a tax webinar. We have 30 folks on, and nobody wants anything out of it. Well, I guess we're done here, right? What do we want to get out of this? All right, I'll wait for those responses to come in, but a quick update here on income tax brackets, as well as capital gains tax brackets, as well as a standard deduction for 2024. Then we're going to go more into behind looking, right? Because those 2023 tax returns, they're going to be coming. And when your consumers get that tax return and complain about all the taxes that they paid, wouldn't it be cool if you can say, you know, I could probably help you out if you let me see your 1040. I could probably help you minimize whatever it is, the Social Security taxation that they got. Maybe they don't want to. I don't want required distributions. They're forcing me to take required distributions, Charlie. How do I not take them anymore? Well, it's not quite that easy to just not take them anymore, but are there things that you can do to reduce the taxes on that or redeploy the required distributions? Folks, I have the cheapest top 50 life insurance companies in the country. And I don't mean cheap as in cheap. I mean low price, but yet good quality. We have AIG, we have North American, we have Banner, we have Protective, we have, go down the list, 50 of the top carriers. An agent said yesterday, I liked what he said. He said, a good IMO, he said this, and it was very profound to me, and I'm going to steal it. He said, a good IMO should be very representative of what the market offers out there. I said, that is the best explanation that I have heard, especially when it comes to what we were talking about, term insurance. It should be a great representation. So if I come to you and say, here's the cheapest product, but yet it has this or doesn't have this, here's the second cheapest, has this, doesn't have it, that should be representative of what the industry is versus I have one product and I'm just selling what somebody told me to sell. Then you, the agent, are like, is there something else better out there? Usually people don't have doubts when they work with me, but why do I go on the life insurance tangent thing there, right? Required distributions, you don't want it anymore, or you don't want it, period. What if you reallocated that to, say, a life insurance policy? Although we're talking people in their 70s, well, if I can find a really, really cheap life insurance policy for that 70-year-old, GUL, for example, what does that do? And they call this legacy maximization. What does that do from an after-tax estate standpoint here? All right, so we have a few here. Let's see, things I can show the client on their tax forms to bring some value and tax savings into the conversation. Cool, you're on the right call. Speak about using the 1040 to find opportunities to soften tax dollars. Yep, same thing basically, just said differently. Capital gains, 47,000. Is a $47,026 just earned income, or does it include capital gains as well? I'm going to give you an example of exactly that. I have a lady who bought a house for $250,000. She sold it for $1 million. She makes very little income. So the question is, so in that year, how much income, how much does she have that is taxable to her, right? And what brackets does that put her in? So we have a case study here that I'm going to go over. Great question there. All right, if you have anything else, bring them on in. All right, so these tax brackets are the same from a percentage standpoint, just the actual brackets, the income, because of inflation is about, I would say 5 to 7% higher, just back of the envelope, just as I was updating these. I would say 5 to 7% higher than where they were in 2023. Capital gains tax, the same thing. I would say 5 to 7% higher than they were in 2023. And then you have the net investment income tax. Now, what is this? And then I'll go back to my little case study that I mentioned here. That is, if people make enough money, that net investment income tax, there are certain vehicles, say like non-qualified annuities, right? To where if you get interest and if you are making over $250,000, for example, married filing jointly, well, you are not just taxed. How is annuity income taxed? Or how is annuity gains taxed? Is it capital gains or income? It's income. So if you have, say, a $100,000 gain and you make $300,000 a year in taxable income, come over here, then that $100,000 is probably going to have around a $24,000 tax bill, right? But not just that, you're also going to have an additional 3.8% because the government basically said, if you make a lot of money on these certain vehicles, annuity income, not IRA money, right? IRA retirement vehicles do not have this net investment income tax. But what the IRS has said, if you make that much money on these certain vehicles, CD interest as well, you are going to pay an additional 3.8% in addition to what you otherwise would on the taxes. But anyway, the 200,000 for single filers there, 250,000 for married filing jointly, that's the same as it was the year previously. So here's a quick story to get to Mr. Joe's question here. 2 years ago, 2022, one of my great clients came to me. I love her. Her name's Bonnie. She came to me and said, I need your help. Here's what's going to happen is we have a home in Colorado. We have only $250,000 into it. We're selling it this year for $1 million. Crazy, right? But they put a lot of work into it. Which is a whole different conversation. Do you have receipts of all that work that you put into it? But that's a different conversation. So she says, Charlie, I bought it for $250,000 and we're selling it this year for $1 million. She is single, technically a boyfriend, but she is filing taxes single. Now, what questions do you have for me as we try to figure out? Tell me, what questions should I ask Bonnie? Which I did. What questions should I ask Bonnie in order for me to assess what her tax liability is going to be on this house that she is selling for $750,000 more than what she put into it? What questions do I need to ask Bonnie? Boom. Yes. Has she lived in that house for at least 2 years? 2 out of the last 5 years. She has. Now, why is that important? Because the IRS says that in order for you to qualify for an exclusion, meaning, well, $750,000 gain, does she have to pay taxes on all that? Well, there's an exclusion that the IRS says that she can get if she lived in that house for 2 out of the last 5 years. Folks, for a single person, what is that exclusion on real estate? And this is not some weird thing that I'm just pulling out of the air here. Your folks are buying and selling houses as we speak, buying and selling residences as we speak here. This will come up. It probably comes up a lot for you. What's my tax liability going to be? Do I have to pay taxes? $250,000 is the exclusion that she would get. A couple, it's $500,000. Okay, so what does that mean? Then that means If she has otherwise a $750,000 taxable gain, well, subtract $250,000 from that. So she is going to pay taxes on $500,000 of gain, of long-term gain, because she's been in the house. I don't remember how many years, but certainly more than 1 year, more than 2 years, obviously. So $500,000. Okay, so before we calculate her tax bill, let's mention a couple things here. What about her income, folks? Very, very important question. Very, very important question. Her income, Armando, that's not correct. Because you're jumping the gun, I'll tell you here in a bit. Her income, just her normal income, Social Security, what else? What does she do? At the time, she worked part-time. I think she did some stuff with, UPS at the time. $40,000. So $40,000 a year. Let's call that $40,000 in taxable income. Forget the house. So with that, what income tax rate is she going to pay on that $40,000 that she has, or that she had coming in over that year's period of time? What is that income tax rate that she's going to have in that year? Remember, she sold the house for an additional, $500,000 after the exclusion. What is the income tax rate? Because she asked me this. Holy crap, Charlie, is all of my income going to be taxed at a huge amount? The answer to that question is no. Income tax rates are not impacted. And then we'll get into this when we go over the 1040 here, because it's confusing. At the end of the 1040, you have just one taxable income number, right? Just one taxable income. And that's going to be big for Bonnie. Her taxable income number is going to be big. So her taxable income is, call it $540,000. Well, then does that mean that she's going to be paying, 35% on all of her income? No, because then it separates, it bifurcates to where you have one chunk that's income and then the other chunk that's capital gains. So yeah, as a few of you have said, her $40,000 of income, that's subject to a tax rate of 12%. Now, here's a dumb question. Does that mean that 12% times $40,000 is what her tax bill is going to be? Side question here. Does that mean that 12% times $40,000, that's what her tax bill is going to be, at least when it comes to just the income? No. That's called marginal tax rates, right? Because she has a chunk at 10%, a chunk at 12% there. She's in that second tax bracket. We'll come back over here though. Okay, so we've established that her $40,000 is over on the left, the income tax liability. That does not include, said another way, the large amount of capital gains does not impact the income taxes. So question for you, what about the other way? Does the income taxes impact or get added to the capital gains when we're looking at brackets? Does the income that she has impact what she is going to have to pay from a capital gain standpoint? And this is a calculation that I had to do, and I hit the nail right on the head. The answer is yes. The answer is yes. So going from left to right, that does impact it. So in other words, her taxable income for purposes of capital gains would be, call it $540,000. So what does that mean? It means that that 20% on her gain, $500,000. Well, let me ask you this. So is it 20% times $500,000? Or is it marginal, like what we just talked about with the income tax? Is it 20%, to simplify, 20% times $500,000? Or is it marginal, like what we just explained with income? This is what makes a tax code so complicated, is you have this over here, but not this over here. This impacts that, but that doesn't impact that. The answer is it's not marginal. It's 20% period on that $500,000. Sal, the marginal is on the income, not when it comes to capital gains. So call it 20% on $500,000. So what I told her was, whatever it was at the time, I don't remember the exact dollar amounts, but I hit it right on the head when I did the calculation. Okay, so that's a little bit about income and capital gains. Oh, she says, is there any way to offset that capital gains that I would have gotten? And what did I ask her? I said, do you have any, which this is when her and I were just getting to know each other. Do you have any other securities accounts? Because what would I have proposed if she had a stock, for example, that had lost $200,000? Well, you can offset that gain, right? And this is where we hear of capital loss harvesting. And a lot of advisors, I'll tell you, even if you're not an advisor, you're just an insurance agent, insurance only agent, which probably isn't a bad decision to be an insurance only agent. Many of these advisors, it may not hurt to remind your clients that they do have the ability to do the tax loss harvesting many times, and a lot of them are not doing it. Me as an advisor, as a investment advisor rep, well as a registered rep, I do it every year, tax loss harvest with my clients, but she didn't have anything else. So she got nailed with a pretty big tax bill. Another change for 2024 is higher standard deduction. So married filing jointly, you're looking at $29,200. Many clients today are over age 65, at least a lot of clients that I have, those are the ones with the money, right? So you have an additional standard deduction of $1,550 per individual. So married filing jointly, call that what, an additional $3,100 plus 29. So let's just call it $33,000 standard deduction. Those are the updates for 2024, as well as one last thing. Estate tax exemptions for 2024, $13,610,000. And because if you pass away without using any of your exemption, your spouse gets that. That's called portability. That means that a couple has $27.2 million as a exemption. Is it going to stay, folks, is that going to stay that way for a long time? Is it scheduled to stay that way for a while? The biggest attendance that we've gotten in our webinars is our estate planning webinars. We're on section 2 of the series. But folks, if you haven't joined those estate planning webinars, you're either not getting my emails, you're getting the emails, you're just not reading that part, or you're reading that part, for some reason you're not attending them. The biggest attendance that we have, as well as the best reviews that we've gotten, are on those estate planning webinars. Last week, we talked about probate. Next week, we're firing them back up, and we're talking about methods of estate transfer, probate, by contract, by beneficiary, by law. And what does that, oh, and trusts as well. That's what we're talking about next week. But that's right. This is not going to remain at 13.6 million for the foreseeable future. As a matter of fact, in 2026, it's probably going to go to somewhere around $7 million per individual. So if you're fortunate enough to have clients that will soon have an estate tax issue, or maybe already do, because of the changes that are going to happen in 2026, the sunsetting of the Tax Cuts and Jobs Act, then what can you do? You can look at gifting strategies today, and that's what we're talking about in the estate planning. Oh, well, but Charlie, what if my client and his wife, for example, gift $20 million today? And then that estate tax exemption, somebody asked, what states are you licensed in? Pretty much all of them. All of them that matter. And I don't know, Mary, if you're talking about as an IMO. In a lot of states, you don't have to be licensed as an IMO to work with the agents. So I have a lot of states like that. Personal production, I'm in a ton of states. But effectively, consider it in all states. And it's easy to get licensed in each state if I'm not. Okay, so can the IRS, if you gave away 20 million bucks, the estate tax exemption goes to only, 7 million a piece, or 14 million for a couple. Are they going to recapture that? They've made it clear there is no recapture, right? The IRS has made it clear there is no recapture. But the gifting conversation, The gifting conversation, it can get sophisticated. That's where you work with somebody like me that talks about this stuff, maybe not every week, but probably every other week, as well as Medicaid compliant annuities, getting folks on Medicaid when the nursing home comes calling for their money. And estate tax rates, we say that the estate tax rate is 40%. It basically is in most cases, right? Although technically it's a sliding scale. But if one has more than $1 million over the exemption, it's 40%. Almost everybody that has these issues have more than $1 million over the exemption, so it's 40%. All right, so here's where we get into the nitty gritty. Here's the flow of how our taxes work. At the top of the 1040, as we're going to talk about, you have income. And what makes taxes, to me, what makes filing for taxes so complicated is you have all these schedules. Ultimately, you have the 1040, which is the granddaddy of the schedules, right? But then you have a schedule that was fed into from another schedule, Schedule 1, for example, that was fed into from Schedule C, for example, that then feeds into the 1040, the tax return. And that's what makes all this complicated. Well, how do we get information to put into this schedule? Well, that is where the reporting comes in, right? For instance, if you cash out a qualified annuity with an insurance company, what form are you and the IRS going to get in the mail? What are you going to get in the mail at the end of that year, which later will feed into these schedules that I'm talking about? What is it that you, as well as the IRS, get when you cash out a, let's say, a qualified annuity? It's called a 1099-R, right? It's a 1099-R. So, okay, well, where does a 1099-R go? Well, I'm going to show you that. And that example is pretty simplified because it goes straight into the 1040, but that many times it's not as easy. But anyway, so here is a way that taxes flow. You have total income, which W-2 earnings, if I'm an employee of a corporation, as I was for like 20 years, don't miss that at all. I have W-2 earnings, taxable interest from dividends. So yeah, that interest was reported to you as well as the IRS, and that goes on the Schedule B, which then gets fed into the tax return. IRA pension and annuity distribution, Social Security payments subject to tax. Whoa, you mean to tell me that Social Security can be taxable? Yes, up to 85% of your Social Security can be taxable if you make more than how much? How much do you need to make more than as a couple in provisional income for Social Security to be taxed at 85%? And I know the answers will come in here. But then what do you get in the mail that year? Remember how I just talked about the annuity? You get the 1099-R. What would you get for Social Security? You would get the, 1099 SSA saying, yeah, here is your tax liability on your $40,000 Social Security. And the answer is if a couple makes more than $44,000 in provisional income, which we'll talk a little bit about, then 85% of their Social Security can be taxed. So what does that mean? So $40,000 is what I got in Social Security. My 1099 SSA says that that $40,000, 85% of that is taxable, which means I now have an addition to my total income at the top of this flow chart to the tune of whatever it is, 32,000, 33,000, 34,000. So you have all that income over there. You also have income from the Schedule 1. So the two important forms, if I can get for every client, this would be my dream. The 1040, which is the granddaddy of all of them, and the Schedule 1. Folks, why don't I care, jumping ahead a little bit, why don't I care about today, the Schedule A? Why do I not give a dang 9 times out of 10 about what is on the Schedule A? I'm jumping ahead a little bit, but many of you will get what I'm talking about. Because what is the Schedule A? The Schedule A is the itemized deductions. Let's talk about the itemized deductions here in a little bit. 9 times out of 10, the Schedule A isn't even a consideration, as we'll talk about, as many of you know about. But that Schedule 1 has a ton of important stuff. Schedule C, how many of you use a Schedule C? I do. I know that. That's business income that's fed into the total income. So forget W-2. I don't even know what a W-2 is anymore, right? All of my income is Schedule C income. Or if you own a bunch of real estate, the top of that Schedule 1 is, and by the way, this comes from Schedule E that feeds into Schedule 1. It's a bunch of calculations on Schedule E. The end result is fed into Schedule 1. That then goes into the 1040 here, right? So you get what I'm talking about here. The Schedule C, all of my business income and deductions, that was on Schedule C. That fed into the top part of Schedule 1, which then fed into the tax return here. But the bottom part of Schedule 1, I like. Why is that? Because that is the adjustment. So when we talk about adjusted gross income, what makes our gross income adjusted? What makes our gross income adjusted? Well, our gross income is all this stuff that we talked about, the total income and everything that feeds into that total income. But these adjustments are a pretty darn good thing, right? What is that? That is, do you have a health savings account? Line 13 on Schedule 1 says, well, here is what you put into a health savings account up to a certain level. Simple IRA, SEP IRA deductions, self-employment insurance. Folks, me as a C corporation, actually, I'm going to come back to that in a bit. We're going to talk a little bit about long-term care in a bit and something you should understand for your business owner employees. Again, the bottom part of Schedule 1, because think of it as two halves. The income up top, down below is the adjustments. Traditional IRA deductions, that's pretty important, right? So our goal should be to help our clients minimize the top part of Schedule 1 that goes into total income and to maximize the bottom part of Schedule 1. Let's take a look at Schedule 1 here real quick. I'm just going to show you real quick, not going to spend a ton of time on it. So again, this is what gets fed into the tax return. You see up here, all of this stuff over here on the right, the upper part of this. Like I said, farm income, that comes in from yet another schedule. You have real estate, that comes in from the Schedule E. Business income, so my Schedule C, my all the forms of income that I get as a business minus my my Zoom account, you know, whatever, a few $100s a month, that goes against that. You know, the total number, the net number goes there, and ultimately that net number gets fed through to the 1040. So this is part 1. This is the top part here. This is what we want to, well, I should say this up here is generally what we want to minimize, right? But what's part 2? This is the adjustments here. So this is the SEP IRA contributions. What do we have here? We have the IRA deduction right there, right? So all of this, the two separate sections are fed into, well, each respective session that we just pointed out here, right? So you have the total income where the top part is fed into up there, and then we have the adjustments where the bottom part, generally the good part, is fed into. Folks, why are these deductions so much better? Why are these deductions so much better than, say, something that is on Schedule A, the standard deduction? Because you also have deductions down here. You have items that are on the Schedule A. By the way, what is the Schedule A? Let's go here. Let's go to Schedule A. So medical and dental expenses, boom. If it's higher than 7.5% of your adjusted gross income, you can deduct those medical expenses, right? You go down here. You know, when I graduated from college, we had a large mortgage. Property taxes are high here in Iowa. So between the interest that we paid on that mortgage and the taxes that I paid, property taxes, these numbers were pretty darn big on my Schedule A, which is itemized deductions. But question for you folks, why do I not really care about this crap anymore? I'm going to wait for this because this is an important part here. Why do I not really care about Schedule A anymore? Because of standard deductions. Because of standard deduction. Standard deduction is superior. That's right. Because here is the difference, but here is the difference between the deductions that you have on Schedule 1 and the standard deduction. Is the deductions on Schedule 1, what is this black thing right here, folks? What is that called? Bear with me here. What is this black thing that goes across here called? And then you're going to get some tax vernacular here. What is this black thing called? That is called a line. And what location is this part up here? What location are these deductions up here? They are above the line. That is why these deductions are the best thing since sliced bread, because these deductions below the line, and I know you've all heard this, even those of you that aren't real familiar with taxes, these deductions that are below the line over here on the left-hand side, 9 out of 10 times, I don't know for sure it's 9 out of 10, but I bet it's close to 9 out of 10, doesn't matter. It's a moot point. I have a gazillion bucks a year in property taxes that I pay in Johnston, Iowa, very high property taxes. I don't get to write those off though. Why is that? Because the IRS says, okay, we figured out what your adjusted gross income is by all of these calculations here. And then we're going to go into the 1040, by the way, folks. What you will actually see, this is just simplified, but then what you will actually see of the clients to where you can make sense of all this. But the IRS says, okay, once you have your adjusted gross income, there's a branch in the road and you can only take one of those two branches. The first branch is you could take your standard deduction, which is the sum, remember, the sum of all of this stuff right here. The excess over 7.5% of your adjusted gross income. And by the way, that's why minimizing adjusted gross income is important, because many things depend on you don't qualify for if your adjusted gross income is too high, right? So that adjusted gross income number is important. But the IRS says, okay, you add all this stuff up, your itemized deductions, you add all that stuff up, and you can use that method if you want. You can take the itemized deduction. I think I was going backwards here on what I was pointing out, going too fast. You can take the itemized deduction route here if you like, or you can choose a standard deduction. Well, let's say my itemized deductions for me and my wife are $15,000 per year. What am I going to choose every single time versus a standard deduction of $29,200? I'm going to choose a standard deduction, and that's standard. That's for me. That's for my neighbor. That's for anybody that wants to use that. So when this doubled with the Tax Cuts and Jobs Act, did it double? Am I thinking right? Did it double at the time? It got a heck of a lot bigger. When this doubled, basically the itemized deduction, the Schedule A, basically went out the window because everybody is doing the standard deduction today. Any questions on that? And by the way, if you don't know taxes very well, and if you've gone to a tax preparer, and if towards the end of talking to that tax preparer, you said, oh, by the way, here is what I'm paying on mortgage interest. By the way, here is what I am paying on real estate taxes, property taxes. That person may have looked at you and said, nah, we don't need it. You're like, what? No, please enter it into the system. He may have entered it into the system and it didn't make a difference. Why is that? Because instead of taking our right lane here, 9 times out of 10, you're going to take the left lane. And to a certain extent, it doesn't matter how much property tax, to a certain extent, obviously, how much all that stuff is that you're paying. Hey, what's this green thing here, folks? What's this green thing? Tell me what that green thing is. And why the heck did I put that green thing in there? That is a line. So we have what you are actually going to see, except I wanted to make, I wanted to put that line there. Everything above that, whether you do standard deduction or not, is, going to ultimately impact your tax bill. So this is kind of the bottom 2/3 or so of the first page of the 1040. Up here, you have the dependents. So when you look at that, okay, so you have dependents, in which I thought it'd be funny if I put like the United States government on there and all of the employees of the United States government and a bunch of people in our country that don't want to work that I'm paying for. Put that on your form as dependents and see what the IRS comes. I bet you get an audit pretty darn quick there. But who are your dependents? When I was a kid, I never understood what it meant when my dad, who was full of all kinds of one-liners. Oh, this is my tax deduction here. And would look at me. What did he mean by that? He meant this part of the form here, the child tax credit, right? So, if you see that there are dependents there, what can you talk about when it comes to dependents? And by the way, the child tax credit is if you don't make over married filing jointly $400,000, then each child that you have, you get a credit, not a deduction, but a credit, a tax credit of up to $2,000. Folks, so 2 questions. Number 1, and answer me. Everybody should answer me here. So I can gauge the audience. What is better, above the line deductions or below the line deductions? That's question 1. What's better, above the line deductions or below the line deductions? Keep them coming. We have 30 people on and like 28 of them, nothing. Above the line deductions, folks, is better than below the line deductions. What is better, a tax credit or a tax deduction? What is better, a tax credit or a tax deduction? What is better? A tax credit. That's correct. So what I'm talking about up here, is a tax credit. The thing with a deduction is if you deduct from income, say $1,000, well, by the time you get down to the actual tax bill that you're going to have, that you otherwise would have had on that $1,000, that would be equivalent to deducting, say, $370, right? If you're in the 37% tax bracket. So by having $1,000 as a deduction, to simplify, it's $370 that you're getting effectively. What a credit is at the end of all of this calculation, folks, if you have $1,000 credit, how much is your tax bill being reduced by? $1,000. Credit is better, all else being equal. Credits are better than deductions. But then you have, is it refundable? Is it non-refundable? Refundable versus non-refundable. For the most part, refundable is if you have zero income, and you get a $2,000 credit, do you get that $2,000? I mean, if you otherwise have zero tax liability, and if you get a $2,000 credit, do you get a check for $2,000? It depends. It depends on if it's refundable or not refundable. If it's refundable, and many folks saw this with the, what was it? It was the stimulus, the stimmies that were going around a few years ago, the stimulus checks. Were they refundable? Were they not refundable? I don't even remember if they were refundable or not refundable, but I know that some of them were refundable because I know that people that didn't have a whole lot of income got checks, but well, and then there was a question of did they have to pay the IRS back later because they literally got checks in the mail, right? But refundable versus non-refundable, refundable, all else equal, is better than non-refundable. All right, so W-2s, we know what we can see on a W-2. Are they contributing to a 401k plan? Is there a Roth 401k option? My good friend David McKnight, he talks about how, hey, Roth is He's not the only one. I believe that as well. Roth many times is where it is at today. Why? Because many folks that are going to retire, especially like in 2030, he says that that is really kind of the deadline where a lot of things in his estimation, and by the way, David McKnight is the power of zero guy. So he talks about having a zero tax rate in retirement. He says 2030 is kind of the day of reckoning, so to speak. Convert or contribute to Roth IRAs, Roth 401ks today versus Roth 401ks. Well, why is that? You know, many consumers don't know what a Roth is, as many of you know, which to me is kind of mind-boggling. Well, with a Roth, you're paying taxes on the seed, but not the harvest, right? With a non-Roth, whether it's a 401k or an IRA, you're not paying taxes on the seed, what you put in, but that harvest later on, you are paying taxes on the harvest. That's a difference between a Roth and a non-Roth. Okay, so here you have on the 1040, of course, you have a bunch of other income here. Let's see, wages from 89. Let's see, and then you add those lines up. So yep, you basically just add all the income lines up, but we also have some additional income that comes in, remember over here on the left, Schedule B, and that is taxable interest. So certificates of deposit. Here is what I have found, and I've done a lot of advertising with probably about 5 different agents that work with CG Financial Group on this notion of tax deferral, right? Annuities are tax deferred. Certificates of deposit of the non-qualified flavor are not. Why is tax deferral going to be a bigger conversation? Because folks, today, as we speak, over the next couple of months, I should say, folks are going to be getting little sections on their 1040 2B over here that's going to be sizable. Maybe not as high as what an annuity can pay, but dang, I have $100,000 in a certificate of deposit. Interest rates have increased, Mr. Agent, to 4%. I now have $4,000 in Section 2B on my 1040, and I have to pay income taxes on that additional $4,000? Absolutely. What if I told you that we can completely zero out Section 2B on your 1040 by moving that $100,000 over to an annuity? You don't pay taxes until you cash it out, until you want to pay taxes. That is called tax deferral. It didn't matter when, well, heck, I had like $50,000 in a checking account, in and out of our checking account that I had tried to keep in there a few years ago. Wells Fargo, I called up at the end of the year at tax season. I said, where's my 1099 INT, right? 1099 INT, 1099 interest. That's how they report the interest that goes into Schedule B that goes on this form. I said, I had like $40,000, $50,000 coming in and out of this all year long. Where's my 1099? Said, oh, you have to have at least $10 in interest. At least $10 in interest over the year for us to generate a 1099 to be sent to you. Those days are gone, folks. Today, those 1099s, even though CDs don't pay as much generally as what annuities do, today you're going to see some pretty sizable numbers in there, and consumers are going to start opening their eyes to tax deferral. Qualified dividends versus ordinary, well, it doesn't matter versus, but dividends. Is this money safe? Is that client in the retirement red zone? Are they 5 to 10 years out from retirement and have a ton of dividends coming in? Ordinary dividends versus qualified, there is a difference there. Qualified dividends are better than ordinary dividends. You basically have to hold the stock for a long enough period of time, at least 60 days over a 121-day period of time in order for it to be qualified. Then you're taxed at the dividend rates. Ordinary dividends. What are ordinary dividends taxed at, folks? A lot of people don't realize this. A lot of people are like, oh, it's a dividend. It's taxed at 15% or 20% if they make too much money. What are ordinary dividends taxed at? So if somebody buys a stock today and boom, is paid a dividend next week because they timed the stock accordingly so that they get that dividend and then sell it the following week, what are those dividends taxed at? Their income tax rate, their ordinary income tax rate. Well, is this money safe? Mrs. Client, what if we looked at, so you're going to need income 2 years from now, you're 63. What if we put your money into a Athene Ascent Pro 10 product? What will happen? Your $100,000 immediately turns into $130,000 from an income standpoint. Then over the next 2-year period of time, you're going to get an additional 12% simple per year on that 130, 154,000. You retire at age 65. And what is the payout that you would get on that $154,000 benefit base? Guys, it's something crazy. It's like $8,000, $9,000 versus a reasonable assumption, 4% rule versus like $5,000, $4,500. These GLWB riders have never been priced better than they are today in the 25 years that I've been in the business. If you aren't selling GLWBs on indexed annuities, talk with me about them. That example that I just talked with you about, that's real. Put in this 30% benefit-based bonus, 12% per year, payout factor that's much better than a 4% payout factor, and boom, you have big income guaranteed for the rest of that client's life. And that's Athene. American Equity is good as well. IRA distributions. So I wrote an article on this. By the way, I'm going to share something with you. Just a second. I'm going to share a little gift with you all. And it is a tax reference guide. Print this puppy out. This is, with my CFP designation, CLU, CHFC. I get this to hosts and panelists. No, I want to share it with everyone. It's all the numbers that you need to know to talk about taxes. Client says to you, hey, what can I contribute to my 401k plan this year? Some of you may not know because it's early in the year. Well, $23,000 if you're less than 50 years old, or an additional $7,500 if you're over 50 years old, right? So it has all those numbers there. I just shared it. Let me know if you can't see it there. Okay, so IRA distributions. Hey, folks, I get this a lot, and it's this. IRA to IRA. So IRA to IRA. Somebody says, okay, I want the company. Do you have transparencies that one can place over a 1040 when meeting with a client? I do not. I've seen all of the overlays out there, and I put together this information, the best of the best, I think. And I think that, frankly, I think that this overlay would be better than what I've seen out there. I have a lot of different competitors' overlays, companies' overlays that I've seen. They leave a lot to be desired, frankly, but I should take this and create something like that. Folks, what is a direct rollover? Here's what a direct rollover is. And this goes into the reporting here on 4A. I wrote an article about this in Broker World because there's a lot of confusion about it. A direct rollover is, say, from IRA to IRA. So Athene says, hey, we're going to send the money to you, but the check's going to be made out to American Equity. So the client gets the check, but it's made out to American Equity. They send the check to American Equity. That is called a direct rollover. Folks, is there 20% withholding on a direct rollover? Is there? No, there's not, for two reasons. One, it's an IRA. Two, it's a direct roll. What makes it a direct rollover? In that the check was made out to the other company, not the client, right? Okay, what's an indirect rollover? An indirect rollover is where Athene says, okay, or where the client says, hey, just give me my money, Athene. Just write me the check, and I'm going to, within 60 days, I'm going to write that check back to American Equity. I'm going to do an indirect rollover. They can only do one of those a year, folks. Indirect rollover, only one per year, at least from the same pot of money. With a direct rollover, there is no limitation. Now, question for you, is there 20% withholding on that indirect rollover? The check was made out to the client cashed out that check, they wrote the check back within 60 days to American Equity. There generally is no 20% holding there as well. Why? Because it's an IRA. A lot of people are like, oh, they're going to withhold. They're going to withhold. No, it's an individual retirement account. We're not talking 401ks here. Now, with both of those scenarios, is there a 1099-R reported that will later go into this particular formula right here. Yeah, there is. Now, okay, so that's great. So they're taxed on it. I thought the whole purpose of rollovers, well, but those are offset by the company sending out a 5498 later on saying, yep, we received the money, right? But in both those cases, and I argue with CPAs all the time, and and I'm right every time. Otherwise, I wouldn't be arguing with them. But it's, hey, we should have received the 1099. Or, hey, why did my client get a 1099? They shouldn't have gotten one. No, as long as it's a rollover, they're going to get a 1099. Or the opposite, the last of my three categories. And I have an article I wrote on this, laying all these three categories out. We talked about direct rollover, indirect rollover, direct transfers. What is a direct transfer? A direct transfer is going from Athene directly over to American Equity. For example, custodian to custodian. Is there a 1099 generated in that example? No, there's not. CPA calls me up. Where's our 1099? Where's the 1099? There's no 1099. Well, but it's a rollover. No, it's a direct transfer. Isn't that the same? CPA. No, it's not the same. There are big differences between indirect rollovers, direct rollovers, and direct transfers. Now you know, right, folks? So a lot of confusion happens with that. That's where that would be reported. Pensions and annuities. Okay, so you have a pension plan here, or you have annuity income here. That can generate conversations for you and the client. By the way, oh, there it is, Social Security. Wow, Mrs. Client. So you're getting, remember my example earlier? You have $40,000 in Social Security income, 6A, and $32,000 of that Social Security income, roughly 85%, is being taxed. That's over here in 6B. Folks, that's where you would find that, right? If their Social Security is being taxed. By the way, here's a side note. Actually, I'll go into the side note, IRMAA. I'm going to talk about Medicare IRMAA in a bit. Then we're going to get done, say 5 minutes late. So in 3 minutes here. Let's see, capital loss harvesting. That's up one notch. It should be down. Coming in from Schedule D, capital gains or loss. Wow, so you have that should be down around 7 there. So you have a capital gain that's being reported here. Is your advisor doing what we call capital loss harvesting? What do we have here? We have business income. Again, that comes in from Schedule 1. Remember how the Schedule C feeds into Schedule 1. What is line 10 on Schedule 1? Well, line 10 on Schedule 1 is basically all of these added up together effectively, right? So all of that additional income, farm income, Schedule C income, farm income being Schedule F. So that is where that Schedule 1 income is incorporated in there. But the bottom of Schedule 1, let's go down here. And then you have the bottom of Schedule 1, which is those IRA deductions, simple IRA deductions, long-term care deductions. Here's a thing on long-term care. Why did I put long-term care deductions up here? Why did I put long-term care deductions above the line? So whether they standard deduction or itemized deduction, why long-term care deductions up here? I did that to prompt my memory to tell you this. Long-term care deductions for business owners are an above the line deduction, right? No 7.5% calculation. It's an above the line deduction. Well, how is that an above the line deduction? In Schedule C, there's a part in Schedule C, or is it Schedule 1? And it flows. Is it Schedule C and it flows through, or is it Schedule 1? But there is an area that says self-employed health insurance. So by being a business owner, that is an above the line deduction, right? Versus below the line, in order to get a deduction for long-term care insurance, we have to do what? We have to itemize our deductions. And only when you have 7.5% or more, or I should say health expenses 75% or more than your adjusted gross income, are you able to do it? In short, by a business owner being able to deduct their long-term care premiums to a certain extent, that is absolutely huge because we're talking above the line there, right? So that's a conversation you can have with them as well. How much can they deduct? Well, it depends on what their age is. These are the age-based brackets here. If they're 61 to 70, they can deduct up to $4,700 of long-term care premium against their income. And technically, if they own a like C corporation and they're an employee of a C corporation, there are ways to where these limits don't even apply. But for the most part, the point here is can a business owner deduct long-term care premiums above the line? The answer to that question is yes. But for additional details, feel free to talk with me. And lastly here, Irma, Medicare. My lady Bonnie. So I'll finish how I started. How much is she going to pay in Medicare premiums? 2024. I was going to say 2023. I didn't want to get too tricky with the questions. In 2024, because remember, all of that happened in 2022, right? All that happened in 2022. So all of that adjusted gross income that she had in 2022, what does that mean for the 2024 Medicare year? Boom, $594 a month, $594 per month. So that age, the Medicare program, which is health insurance for those that are age 65 or older, not employed. You know, there are exceptions if they're employed to where they don't have to file for Medicare. But generally 65 and older, it's health insurance, right? 2 years ago, whatever their modified adjusted gross income was as of 2 years ago, that's what determines what she's going to pay today. Yeah, I actually should reach out to her because I haven't talked to her since late last year, a couple weeks ago. So I should probably say, remember, Bonnie, what we talked about here, you're going to be getting not a $174 Medicare bill. You're going to be getting a $594 Medicare bill. And then, of course, you have Social Security taxation, which I'm not going to go into. We already talked about that a little bit. Folks, make sure you fill out the evaluation. By the way, I don't think I updated the evaluation. So if the wording in there looks a little funky, maybe a couple years old, just ignore that, but still fill out the evaluation. Tell me what you think of this webinar. Estate planning is firing back up next year, or next week rather. And I need to get on a diet because I ate too much over the holidays. So I'm going to go to the gym here real quick. But folks, fill out the evaluation. Tell me what you thought. And if you're not appointed with CG Financial Group, why not get appointed? Like I said, a lot of these companies do dual appoint. So with that, I'm going to close out here and the evaluation is going to pop up any second now. Talk to y'all later.